Hi friends. This month, while talking to you about UTI Mastershare Unit Scheme, a large cap oriented equity fund, I would like to start with the importance of large cap investment in one's equity allocation. Most large cap companies come with resilient business models that help them to not only invest for sustainable growth but also to handle the difficult and challenging periods better on the basis of the strong financials as well as the management bandwidth. Typically, these companies enjoy strong market shares or leading market share and the scale benefits. Large caps in past have also been good compounding growth stories, and I think the volatility in large caps is lower than the mid cap and small cap companies. In terms of master shares allocation to large cap, that is the top 100 market cap companies, we are at about 89%, and 11% is invested into mid and small cap companies. The investment approach that Mastershare follows is growth at reasonable price. That means what is the reasonable price, what is the price that we are willing to pay for the underlying growth. We follow top-down approach to select which sectors we want to go overweight and where we want to stay underweight, and then select stocks based on the in-house research team inputs and our judgment on what stocks could outperform in the future. Our focus also has been to look at companies which have strong competitive franchise. That means the companies which enjoy competitive advantage over a long period of time, that actually creates strong entry barriers and enables companies to have profitable growth and also invest for future at a high return on capital employed. These comes because of the pricing power benefit or the cost of production related benefits. The current portfolio for Mastershare looks as this, that we have about 35% weight in financial services, where the focus has been on the private sector banks, which enjoy strong liability franchise and also which have capital adequacy is strong. The NBFCs, the ongoing liquidity crisis made us to come out of certain NBFCs where we think that the difficulties could persist, and we have consolidated our exposure into strong HFC, which is in a comfortable position and might benefit out of the competitive advantages that it enjoys. In IT, we have taken partial profits because we think that the prices and the valuation was, favorable to kind of take some profits, but we are overweight on the sector because of the sustainable cash flow generation and the ability to sustain that in future also, and high return on capital employed. On consumer, our focus has been clearly on the consumer discretionary place. We think that the growth runway is likely to be much longer. So, though on a growth at reasonable price, some people might think that how is it that consumer is at reasonable price? I think you consider the growth, long growth runway, we can always justify, and the competitive advantages that these companies enjoy, we can justify holding these companies. Automobile, which has been the performing sector for last 1 month, we have benefited out of our overweight position in four-wheeler and two-wheeler. Here also, the aspirations that Indian population have, the demand growth that we could have over a long period of time, and rapid urbanization and some of the catalysts which we look for. We are underweight on sectors like utilities and metals and energy, for example, and we continue to remain underweight on those sectors. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.